You know, if you have been keeping an eye on Canadian mortgage rates over the past months, you might be feeling some serious whiplash. The number seems to be going one way, the big announcements are saying totally something else, and honestly, it's leaving a lot of homeowners just scratching their heads. And this is the big question, isn't it? The Bank of Canada makes an announcement, they hold the line, and then suddenly the quotes for the fixed mortgage just jumped. If you're looking at all this and feeling totally confused, I'm here to tell you you are not going crazy. There is a real reason this actually happens. And once you understand it, the headlines stop feeling so absolutely random. If you're new here, I'm Jenny, I'm a mortgage agent, and I help people across Canada make smart mortgage decisions, whether you're buying, renewing, or just trying to lower your payments. If you want to talk about your numbers, please click the link in the description and book your meeting with me. And if you want more simple, straight to the point mortgage videos, hit the like and subscribe and turn on notification for yourself. All right, so we are going to break down exactly what's going on here. And I promise this won't be a bunch of jargon. By the end, you will know what actually moves your rate. All right, so let's dive in and really start to pull this mystery apart. So the very first thing we need to understand that there are two powerful and totally separate forces pulling the strings on your mortgage rate. And here's the thing, they can move in the same direction or in the opposite direction, and that's when the people feel that whiplash. Now look, this is for any Canadian with a mortgage. But if you fall into one of these three groups, you will want to lean a little bit closer. First, if your renewal is coming up in the next year, you are in the perfect spot to shop around, plan ahead, and not get pressured into signing something super fast. Second, if you're currently paying 4.5% or more, yeah, there could be a clear path for you to save some serious cash depending on your budget and your lender. And finally, if you're thinking about refinance or home equity line of credit, you have to know that rates you see advertised online, they almost certainly do not apply to you. Okay, so let's get right to the heart of all of this. Here is probably the single biggest misconception about mortgages in Canada. Most of us think that Bank of Canada is the one and only puppet master right now. Like they move and everything moves. But that's only half of the story. There is actually two complete separate forces at play. They often move in the opposite direction. So if you ever said, wait, the Bank of Canada held, so why did fixed rate actually go up? This is why. Think of it like two different worlds altogether. On one side, you got a variable rate. They listen directly to the Bank of Canada. So when the Bank of Canada held its rate in December, variable rate did not budge. It's that simple. But fixed rate, they march to the beat of a totally different drum, the bond market. In December, while the Bank of Canada was standing still, bond yields moved up and down, and lenders reacted accordingly. So the result is your fixed mortgage quote actually changes, and it can have nothing to do with the Bank of Canada decision. This is actually also why you can call on Monday and get one fixed quote and then call again on Thursday and it's different, even though the Bank of Canada didn't do anything in between. So let's look at that first part of the equation. On December 10th, the Bank of Canada came out and said it was holding its keys overnight rate at 2.25%. Okay, so this is a number that directly impacts the variable rate mortgages and your line of credit. That number didn't move. The number that did move around that same time, the government of Canada 5 years bond yield was sitting roughly around 3% range. Now, just think of this as a wholesale baseline lenders watch for a fixed rate. It's not the only thing, but it's the key benchmark. So when that bond yield rises, the lender's cost actually will rise. And even if it's not a huge move, lenders often will reprice quickly because their margins are thin. What they do, they rise the fixed rate they are actually offering to the consumer. There you go, your mystery is just solved. The Bank of Canada stood still, but the bonds market actually moved, and it's pulled the fixed rates right along with. Okay, so now we know why fixed rates can actually move when the Bank of Canada doesn't. But that still doesn't explain why your coworker get quoted one rate and you got a completely different one. This next part, honestly, this is probably the most important thing any mortgage holder in Canada needs to understand. I call it the mortgage bucket idea. Every mortgage gets sorted into the one of the three pricing buckets. It's not random and it's actually not personal as well. Which bucket your mortgage falls into is what fundamentally determines the rate you are going to be offered. So our bucket number one will be insured mortgages. This is usually purchases with less than 20% down payment where the default insurance will apply. Because the lender sees this loan as a lower risk, they will often offer their best rock bottom rates. Let's talk about bucket number two. So the bucket number two is insurable. This is usually purchases with 20% down payment or more, but the deal still fits a certain insurable rules. So the rates can still be very strong. But it's the third bucket, uninsurable, where things really make change and are different. This is a bucket that often includes the refinance, many rental properties, and homes that don't fit insured or insurable rules. And in these cases, the lenders is taking on more risk themselves, so they price it on a little bit higher interest rate. So here is the key takeaway from this whole story. When you see that flashy headline rate advertised online, it's almost always for the first bucket, insured. And sometimes that can be insurable as well. So if you are refinancing or buying a rental property, that rate often will not apply to you. And that one piece of information explains so much of the frustration that people actually feel when they're shopping for the rates. And we are not really talking about a tiny difference. Insurable pricing can be noticeable higher, sometimes by 0.5% higher, sometimes more depending on the lender and your specific file. So knowing which bucket you are in sets your expectation realistically right from the start. We are covered why behind the rate moves and what's behind the rate differences. Now let's get into the how. How do you use this information to make the right call between the fixed and the variable mortgage? It really boils down to two simple questions. First, please be honest with yourself about your risk tolerance. If the idea of monthly payment moving up by $100 or $200 would keep you up at night, that's a real signal. Second, think about the future. Are you absolutely sure you'll be in the same home for the full 5-year term? If there are any chances you might sell, refinance for the renovation, restructure your finance, or life changes, then flexibility matters a lot because the penalty differences can be huge. Variable mortgages often have a simple penalty while fixed mortgages can be far more painful to break depending on the lender and the math they do. So the flexibility becomes a real financial feature, not just nice to have. All right, so let's quickly run through the big takeaways of this video. Number one, fixed and variable rates live in two separate universes. Number two, your situation puts you in a specific pricing bucket, and that's what determines your actual rate. And number three, the lowest rate is not always the best deal. Always check the fine print, especially restrictions like bona fide sales clauses. And finally, your best choice comes down to a trade-off between how much you need certainty versus how much you need flexibility. And I want to leave you with this one last thought. It's so easy to get obsessed with the interest rate, but rate is only one piece of this whole puzzle called a mortgage. The true cost of your mortgage is actually a combination of a few factors. The rate, the restrictions that comes with it, and the penalties you might face. Understanding all three, that's the key to making a truly smart mortgage decision.